Right, last session on the day, we've got Craig French from Visio. Craig for being here. We're all used to his colleague Jonathan normally presenting on either fixed income or multi-asset. Craig, it's absolutely a privilege to have you on stage today, speaking to hedge funds and how they can actually add value to client portfolios. Thank you so much.
Great. Good afternoon, everyone. I realise we're running a long time, so I'm going to try and keep it to the point. It's good to be in Sharks country. My first job was at the old Lucia Mall Health and Record Club. I used to be a sports physio and I used to help look after the Sharks. So it's good to be back. I took a bit of a wrong turn. In 2007, I landed up in hedge funds in London, just before the collapse of Barings, Lehman Brothers and so forth. So it was a very interesting time to go into hedge funds. And I'm going to talk about it as being South Africa's most flexible investment vehicle. I did a short poll before we started today. I spoke to the various managers that are here that also run SA's most flexible hedge fund vehicle, and they all confirmed that the bulk of their liquid net worth is in those fund vehicles. For obvious reasons, it allows them to express their purest view. Just a very brief snapshot globally in terms of hedge funds, $5.2 trillion in size at the end of last year. You can see their pretty rapid growth over the last decade. There are around 15,000 hedge funds globally. The joke is, if they're charging a 2 and 20 hedge fund fee structure, it's super profitable. So, hey, let's give it a bash and see if we can get this right. The reality is 08, 09 washed a lot of the guys out who were really leveraged long, sort of masquerading as hedge funds. But you can see there the industry has 31 sub-strategies in the hedge funds globally. In South Africa, in the main, you have equity long short, fixed income arbitrage. There's some commodity managers, and there are a couple of houses that merge in what you would call a multi-strategy hedge fund. Interestingly, it was Alfred Winslow Jones, who was a journalist from an Australian guy who trained at Harvard. He started the first hedge fund in 1949, so 76 years ago. First hedge fund in the South African context was in about 1995, Decillion, so a much younger industry in South Africa. But thanks to BCI FundRock, we're certainly getting more airtime and seeing growth on this front. And the real thinking behind a hedge fund was, let's sell short companies we don't like. So you introduce what they call short selling. It gives you cash, which you have a low borrowing cost. In South Africa, it costs you about 75 basis points a year to borrow stock. And then you go longer shares that you do like or you do have higher conviction in. So that's really the key thinking behind hedge funds. When I left London, Renaissance Technology is probably the second largest hedge fund outfit globally behind Bridgewater. They were testing UCITS or retail hedge funds in Europe to $100 billion capacity. Their flagship fund, which has been going for 30 years, has generated a gross return of 60% in dollars over 30 years, a net return of 39% in dollars. What they did is they raised their fees to a 5% management fee and a 44% performance fee to get all the external investors out. Two of the clients said, you know what, we like the returns. We're actually happy to stay in and pay those fees. But that's just the reality. That's called the Medallion Fund. It's probably one of the most famous hedge funds out there. Our fees are nothing like that. They're 1 in 20, which is a fairly bog standard model. If you look at kind of these 15,000 funds that are, if you kind of looked at a global survey on those. There are two key goals when it comes to hedge funds, and if you're looking to enter hedge funds, this is what you should be looking for. You're not going to capture all the bull run of the market. That's certainly not what it's designed to do. A rule of thumb for an equity hedge fund is to capture around 3/4 of the market run, but what you're really trying to do is limit the downside. Let me see if I can get this pointer going. Here we go. So you can see over the last, this is 19 years that we've been running our retail version of our hedge fund. On average, when the Aussie is down over that 19-year period, it's down over 3%. We've been able to on average be up 20 basis points over that period. And what that then allows you to do is enjoy this strong positive compounding ahead of the ALSI. It's what Einstein referred to as the eighth wonder of the world, and that's positive compounding. Okay. The second thing you're looking for a hedge fund is, and what you're ultimately paying for, is a source of return that is not highly correlated to equity markets. So what we've done here, we've shown a 12-month rolling return of our retail hedge fund since November 06, and you can see there that it runs with an average correlation of 0.39 to the ALSI, and then 0.49 to the MSCI World. So that's what you're ultimately looking for, a low source of correlation. So you can go to bed at night, the market can have a big wobble, and you can wake up and not be too concerned. And that's certainly been my experience investing in hedge funds since 2008. How do you achieve this? We've got an experienced team, a very diverse team by way of background training. We've got CAs, we've got economists, we've got CFAs, mathematicians, we've got a couple of engineers. And what that allows you to do when you're looking at an opportunity or potential risks problems, you're looking at it through a slightly different lens. And we believe that adds rigor to the process. Just very briefly on Visio, we were relatively a Liberty Cub. In New York, they talk about the Tiger Cubs. Julian Robinson, another very famous hedge fund manager. When guys have left his firm to start their own businesses, they talk about the Tiger Cubs getting set up. Visio is a Liberty Cub, as is All Weather Capital, Shane Watkins, as is Peregrine, as is Centaur. All guys that cut their teeth at Liberty, very much a fundamental investment process. We're very active, and we'll touch on it in a moment, is we like to engage with companies and push them on certain aspects that allows you to unlock certain event-driven return opportunities. And then we also invest locally and globally, again, very much in an active manner. How do we achieve that low correlation at the end of the day? So what I've shown here is just an SA equity index. It's CAPSWIX. The red bars show you the makeup of the CAPSWIX from a sector perspective, and then the blue bars showed at the end of last month our positioning of our hedge fund relative to that index. You can obviously see the lower the overlap, the less likely you are to the market. And that can be achieved through a range of techniques. One is your equity exposure to the market. One is your local versus offshore. Another is inclusion of other assets like high-yield bonds. Spreads have compressed somewhat, but we've done a lot in high-yield bonds over the years. And other instruments, hedging, both single stock hedging as well as through market indices, taking currency positions and so forth. But effectively, you want to make up a portfolio that looks and ultimately moves very differently to the market. Another very useful avenue for Visio is what we call constructive engagement. Offshore, you have activist management like Loeb Smith, Third Point. These kind of guys that go in and they really shake the tree, often take board seats. We don't do that. We like to work constructively with management behind the scenes with the ultimate goal of unlocking value for our shareholders. There's just some examples of letters that we've written to the boards of companies. One being Momentum Group. We looked at allocation opportunities there. Things like share buybacks, we spend a lot of time on. We want to make sure that the right management is in place. We've been invested in Momentum since August 22. It's been a great share. One of our team members has just come back from our 5th trip to India. We like what they're doing over there in terms of their investment in the Aditya Birla health insurance. We reckon it's currently a market's placing a value on that business of 2 billion. We think it's close to a value of 6. And the team were joking with Jeanette Marais, the CEO of Momentum recently, saying, in 10 years' time, we reckon the Momentum results will be announced out of India, and they'll be talking about their subsidiary back in South Africa. So watch this space. Combined Motor Holdings, another one we've been involved in. I'll touch more on that later. And then Old Mutual, a fairly new one. It's a company you've recently seen a new CEO come in there. It's been a woeful underperformer over the last decade or so. But hopefully, we're at the bottom and good things that lie ahead there. I mentioned event-driven opportunities. Again, these are examples of where you can get involved. You can look at either, sometimes it does mean a CEO is replaced at board level, a letter coming in from an outside company versus an issue being raised by a board who've maybe been working together, 5, 10 years. Sometimes it's difficult to raise issues. But if it comes in from an independent party that's raising, that's managing money like ourselves for some sovereign wealth funds, for some pension funds, they're beholden to give you a formal response. And you can also gauge their willingness to affect change within the business. We had penned a letter to Johan Rupert. We've been invested in Net for a number of years, also playing that pensions insurance corp theme you heard about earlier. The team were literally dotting the I's, crossing the T's, making sure that the letter was shipshape for sending off. Was when the Apollo insurance bid came in for Pension Insurance Corp. We still holders there, and you can see they're pretty chunky, 6% of the portfolio. Alex Forbes, we've been in and out and in and out. There's only roughly 16% free float remaining there. It's a highly cash generative business, very capital light, returning capital in terms of special dividends. We don't think it makes sense to be listed given the small free float, so we're expecting a delisting in time. Another share in Victor. Many of you guys may not have come across these stocks. It's very much plays into the whole growth context. It's encouraging to see some growth coming through, but a business there where 2/3 of its market cap is just in its inventory alone. It services into the industrials, into the agri space. They've been doing, again, a lot of share buybacks, and we feel very comfortable with a chunky 7% position in that. And then CMH, also an opportunity. We think they're ripe for potential takeover. The CEO is in his 80s. He owns 35% of the company. Other board members in their 60s and 70s own a further 9%, so that's 44% of the company is on the board, 1/3 of the market cap in cash. They're doing great things with selling some of the eastern car producers, not having relied on the old West so much. And again, we feel we've sent a letter in there, and we think there is potential corporate activity in time. We know some other managers that are involved in the same manner. So again, these kind of opportunities allow you to generate a return which is going to move slightly differently to the market in general. This is Momentum again, just to go briefly through the mechanisms you can use in this most flexible investment vehicle. If you look at the green line, that's Old Mutual, and you can see the woeful underperformance since 22 timeframe. Black is Discovery. What you can do is you can go short those companies. Again, you're paying 75 basis points to borrow the stock for a period of a year. And then you can go longer a company you like and you really see has potential. In that case, for us, it was Momentum. Our investment there's up over 150% since September 22 timeframe. But that just gives you an idea, again, of moving differently to the market. What also happens is because you've shorted one insurer and gone long another, you effectively have gone sector neutral there. So you neutralize some of your market exposure, again, lowering that correlation, and that's what you should ultimately be paying for at the end of the day. Education was touched on earlier. It's a defensive theme. It's a theme in South Africa. People are prepared to pay for education. You can see how Advotech's done versus the market since 2015. Again, some letters, we got involved with some board changes affecting, bringing in guys with relevant experience for the education space. MTN, we've got an Africa team. They've been running an Africa X South Africa dollar fund for the last 15 years, paid a lot of school fees, but it's very useful when they spend time in country, in Nigeria. They get a good sense for management and how close they are or aren't to the regulator. We've seen the history of fines. We saw Rolf Mafita, Old Mutual, management changes. And what it allows you to do is go long and short. So the short, the red lines, the green, when you go long. What you often find is when you cover a short and you think, okay, this is probably kind of hitting rock bottom territory, it's often time to consider going long and start building a position. So that's how we do move the portfolio around. Globally, you can see we talked about Invicta, we talked about CMH, some small caps listed locally that are not well covered by the broker community. Obviously, of very little interest to offshore investors from a liquidity point of view. Many of them can't touch them because the daily turnover isn't large enough. But then you can see we go to the other extreme where we're in some of the hyperscalers. Something like a Microsoft, We talk about it being a little bit like your utility bill. You pay your lights, you pay your water. If you want to operate your business, you pay a Microsoft license. So very much mom and pop stocks, quite defensive. We break the offshore universe down into these 4 key themes there. It just makes it a bit more manageable for us to explain to our investors how we positioned. At the end of the last quarter, we went big into the cooling agent side of things, so carrier air conditioning, Lennox and Train. Obviously, with the data centers, the amount of energy that's required to do all the data processing and backup, you've got a lot of heat that is generated within that. So obviously, the air conditioners are a second derivative beneficiary of that. NVIDIA, this is a slightly old trade, but it's just to highlight the point that, we obviously like what we saw there, market leaders in terms of the semiconductor space. The share had run hard, but we felt it could run further, but there was the obvious risk that there could be the pullback. What we did through Goldman Sachs, we put in a structure that allowed us to, we bought the share, we bought the share at $89, but what we did, and we put in protection that limited the share falling below 84, but it also kept us going above 107. So you limit how much upside you're going to capture, but you're also limiting the downside. What we did to put that structure in place, it was a 6-month structure at a cost of 1.7% to the fund. But at the end of the day, how the market dynamics played out, we were able to generate a 30% return on this investment in just under a 3-month period. So again, you can take a fairly racy stock out there, but through clever option structuring, you can really limit and mitigate some of the risk that you would stand to normally face if you were just buying the share in a long format. This is our retail hedge fund long-term performance. It's been running since November 2009. Just very briefly, you can see there we haven't captured a lot of the downside, but that's allowed us to outperform since inception 14.2. So numbers are a bit small versus the Allsy's 11.5%. Another key component here is your volatility, running at about 2/3 of the volatility of the equity market. The unit of return you're getting for the unit of risk measured by volatility, we're getting 3 times the market return for the volatility if you compare that ratio over there. And again, the big thing again with your hedge funds, certainly in the equity space, an acceptable down capture or participating when markets fall is about a quarter, and that's been our maximum. The market max over the 19-year period is 40, down 40, and we've only captured 10 of that in aggregate. For those, can I ask just by way of show of hands, who does have hedge fund exposure at this point in time? So a fair number, which is good to see. Visio started as a hedge fund. We do also run other multi-asset funds. Interestingly, when we run our strategic asset allocation for our global balanced fund to work out what the optimal mix of local and offshore assets is to achieve a CPI plus 5 at lowest volatility, we put in our retail hedge funds into that mix. And on an unconstrained basis, it suggests that we allocate 65% of their assets to that retail hedge fund. And that's, again, looking at risk-adjusted and drawdown type numbers. So certainly very attractive. Last slide, again, this is just showing we've received some 5-year awards for our global balanced fund, our flexible equity fund, our multi-asset income fund, and then also for our hedge fund. So it's not just a flash in the pan, but really the hedge fund brings together the best ideas across all of these various asset classes into one product. Great. Thanks very much, everyone. Are there any questions?
Right. Craig, sorry, in 30 seconds, I'm only going to ask you one question. Hedge funds, and I know we run all these hedge fund workshops once a month. A lot of info there on hedge funds and how the structures work. But some people still ask, they say, but if a hedge fund can short a stock, it means you can lose more. Why won't a retail hedge fund not lose a client's money, everything gone?
Yeah. So I think at the end of the day, it comes back to who's managing the product. And we're very fortunate in South Africa to have some very skilled hedge fund managers, so much so that a a lot of sovereign wealth funds and family office institutional investors in the US, Europe, Asia invest with South African hedge fund managers, just a recognition of the skill. A large part of the reason behind that is the normal thing you do when you look at a hedge fund's track record, you go straight to 2008 and go, how did they perform in that period? And many of the managers here were maxed down roughly around 5%, where the market was down around 23%. It comes down to risk management. You've got to do the work so that you have conviction, and the reality is in your shorts, you have to almost do more work because of the potential for it to move. But again, it's sizing, and then it's having the discipline that if the thesis is not playing out, you have to cover that short, and that's key. Yeah, and I think, again, having certainly on the retail side, we've got 19-year history of demonstrating that we haven't, where there've been some big market moves over the time, but we haven't participated.
Yeah, I think it's very important when you do look at hedge funds, look at the manager, look at the quality, look at that risk management skills. And I mean, Visio has illustrated that very well in all your products, I think, for the past 15 years and beyond. So well done with that. Craig, thank you so much for joining us here. Yeah.